This is part 5 of our Chapter 3 video lecture series, and we've just finished journalizing adjustments in the previous video, again under all these different categories. Let me show you again how those adjustment entries look like. So this is just examples, not the same ones we had done in the previous video, but you're going to your general journal and writing in here the date at the end of the period, and you're recording that debit and credit for each adjusting journal entry. Most adjustments are either debiting an expense or crediting a revenue account. Yeah, if you're not doing that, probably you're doing either a transaction or correcting entry. And we would take these amounts and post it to the ledger accounts in the general ledger and pull the balances into a new adjusted trial balance. But we can use a different tool that's illustrated in our textbook, if I can find it here, called a worksheet. And so most accountants use Excel, Microsoft Excel or Google Sheets to help them do their work. And here is that trial balance before we had posted any adjusting entries we had just prepared. But instead of going straight to the journal and trying to figure out what the adjustments are, it may be easier to use this worksheet and use these next two columns in the sheet to kind of figure out what the balances should be. So you kind of go down the trial balance and figure out, is this the correct balance? Do I need to adjust it? In this case, no, we just carry over the balance to the adjusted trial balance. Here for accounts receivable, hey, doesn't our customer owe us some money because we did some work? Well, then that we need to adjust this balance. And the only way to increase or decrease any account is to journalize it with debits and credits. So here we're going to increase that receivable account with a debit. And we know every time we record a debit to one account, another account has to be credited. So we have to kind of figure down here which account needs to be credited. Here, this revenue account, increasing revenue. So you notice how they match it up with letters, this F here and F here. Or here, the next account, we don't have $9,720 of supplies here on December 31st. We had counted only $8,670. So we got to reduce this balance down to this amount that will eventually be reported on the adjusted trial balance. So we're going to reduce this asset with a credit here for the difference. And again, every time we record a credit, we know another account has to be debited for the same amount. So here is that other account being debited. So we know from the totals of our trial balance, total debit balances have to equal total credit balances. Now in this adjustment column, total debit adjustments have to equal total credit adjustments. And we're adding and subtracting going across each account row here to get new adjusted balances. And again, total debit balances have to equal total credit balances. And if you don't have matching debit and credit totals down here, you know something is wrong and you got to try to find out what that error is. Let me illustrate now adding or subtracting going across. Here in the case of cash, you only have a debit balance and no adjustments. So the same balance will carry over to the adjusted trial balance. Here you have 0 for receivable plus 1,800 debit, so you end up with a positive 1,800 debit here in the adjusted trial balance. In the case of supplies, here's a debit balance, and you're crediting that account. And we learned back in Chapter 2, when you combine debits and credits, you never add the amounts together. You always take the difference. Here we have more debits than credits, so the difference is a debit balance here in the adjusted trial balance. Same thing with the prepaid insurance. Here's that new account we learned about in this chapter called accumulated depreciation. And it's a contra asset, so the normal balance is a credit. Nothing in the previous period. So we're just starting this account here with a credit balance. Let's see here, unearned consulting revenue. This is a liability. We owed our customers $3,000 worth of services, but that's not correct. We did some work, so we're going to owe less. So here's part of that adjustment. Combining credit and debit, again, you take the difference, and because the credit is bigger than the debit, the balance, the difference is a credit balance here in the adjusted trial balance. Okay, so again, the worksheet, I'm not going to make you do one, but this is very useful for real life accountants. And in a glance, they can see almost everything here that needs to be updated. Yeah. So we're going to take now this adjusted trial balance like we had done in previous chapters, and then do the next step, which is to prepare the financial statements. So here is that same adjusted trial balance column, the two last columns of that worksheet. So we're going to take the revenue, these two amounts here, and take all of these expenses and rewrite it on the company's income statement for that period of time, the month of December. We subtotal the revenue, we subtotal the expenses, and we take the difference. It's going to either be a positive net income or a negative net loss. And then we move it over to the next financial statement, which analyzes the company's retained earnings. Right now, if you take a look at this trial balance, there is no account called retained earnings, even though you see it down here on the balance sheet in the equity section. Okay, so we take the revenue or the net income and add it to any previous retained earnings. We minus out any dividends paid during the period to get the remaining retained earnings. This remaining retained earnings will move up to the top here for the next period, January 1st. But anyway, now we have our assets and our liabilities, and we rewrite it here on the company's balance sheet. Notice these two numbers here. Again, equipment and then the related accumulated depreciation for the equipment, that new account we learned here for recording adjustments. And we take the difference, and then that difference, the book value, is added to all of the other asset balances to get the total assets. And then we have liabilities. The equity, we just copy the common stock down here. And then for retained earnings, again, there's no retained earnings account here. What we're doing is recopying it from this previous report, the statement here. So really in this retained earnings of 3,585, we're squishing in there all the December revenue, expenses, and dividends into one figure, like you see over here. Yeah, all of these numbers right here. And then making sure, just like in our accounting equation, total assets are equal to total liabilities plus the equity. And you can see the matching grand totals over here. Okay, so we're done now for the month, for the period of December. And what we want to do is get ready for the next period, next month, next year. So we don't want to mix up this month's revenue, expenses, and dividends with next month's or next period's revenue, expenses, and dividends. So what we got to do is zero out the amounts here for revenue, expenses, and dividends. And the only way we learned how to change account balances is to journalize the change. So going back to the general journal, not journalizing transactions during the month, not journalizing adjustments at the end of the month, but now journalizing what we call closing entries to zero out the accounts after the month is over. Here we call it closing entries that are journalized, debits and credits, in the general journal. Then we repost it to the ledger accounts in the general ledgers to zero out revenue, to zero out all the expenses, and to zero out the dividend account. So here is the accounts here represented by T's that we're going to zero out. So revenues are closed out first. There's four, as you can see here, described closing entries. The first closing entry is to close out all of the revenue accounts. That's this consulting revenue that has a credit balance of 7850 and the rent revenue account credit balance of 300. If we want to zero out credit balances, that means we have to debit those accounts for whatever the balance you see over here. Okay, so we're going to debit consulting revenue, debit rental revenue. And of course, when we prepare a journal entry, you have to have equal debits and credits. Okay, so debit, debit. Now the credit is going to go into this new temporary account called income summary. Just like the name implies, it's going to summarize the company's net income or net loss. So here is the revenues total being credited to offset these two debits. That's the first closing entry we're going to journalize, number one. The number two closing entry is going to close out all of these different expense accounts that have debit balances. And to reduce the debit balances to zero, again, we want to make sure we're starting from zero for the next period. We have to credit those debit balances for the same amount of the balance. So we add up all of these credits, and the total now has to be debited to another account. And that's going to be this temporary income summary account that you already see the revenue here. Now you see the total expenses here. And if you combine the debit and credit, you're going to have a balance of this net income we saw back on the income statement. Let's see if we can find that. 3,785. Let's see, income statement right here at the bottom line, 3,785. Revenue and expenses. Revenue and expenses. Okay, so that was closing entry number two, closing out expenses into the income summary. Now, closing entry number three is to close out this income summary account itself. Right now, we have a balance of 3785. So we're going to debit that account for the same amount. So when we debit this income summary, another account has to be credited. Here, the retained earnings. And you can see you're starting off with zero because this is a new company, yeah? And even though you saw retained earnings on the company's balance sheet, it's really zero. But now we're going to we're going to update the retained earnings account for the amount of the net income, okay? Credit, offsetting this debit. That was closing entry number three. Now, closing entry number four is to close out the dividend distributions we gave our shareholders during the month, which is recorded with a debit. Now we're going to zero it out with a credit. And when we credit this account, the offsetting debit at the same time is journalized and posted to the retained earnings. So now this amount here matches the amount we saw at the bottom of the retained earnings statement and also rewritten on the company's balance sheet. 3585. Let's take a look at that again. Here at the bottom of the retained earnings statement and rewritten here on the company's balance sheet. So when we journalize those closing entries and post them to the general ledger accounts, right now your revenue accounts are zero. Your expense accounts have zero balances. The dividend account is zero. This income summary that we use just temporarily is already now zero. But the retained earnings is not zero. We've increased it. Here you can see to the correct $3,585 balance. What we can do right now is pull all those balances updated, including the zero. Well, we don't pull zeros, but it'll be blank balances into a new post-closing, after closing trial balance, where we show the same assets as we had before in the previous trial balance, the same and contra asset is $300 accumulated depreciation, and the same liability accounts and common stock accounts. But in the previous trial balance, retained earnings was zero. But now we have the amount of the uh, correct amount in there. But you don't see now any revenues here. You don't see any dividend or expenses here because they're zero, they're closed out. Now we're ready to start all over again during accounting for the next period, January or the next year, whatever period we're looking at. So starting all over again is called the accounting cycle. These are all the steps we do in one period of time, be it a month or a year. If you remember, we started way back in chapter 1, recording transactions, or in chapter 2, journalizing those same transactions in the general journal. And then we update or post those amounts to the general ledger accounts. And we pull the balances into a trial balance. But we learned here in chapter 3, those balances may not be updated. So we got to journalize some more. Even though you see the journal here and the journal here, it's the same journal, yeah? But this time here, we're journalizing those adjustments. And for most students, adjustments are probably the hardest thing we do here at the beginning of the semester. And just like any journal entries, we post them again to the ledger. Again, this is the same ledger up here as down here, yeah? And then we pull the balances and we make another adjusted trial balance. Here, the last two columns of the worksheet. These two columns here would be this unadjusted trial balance up here, yeah? And then from this last two columns, we can prepare those financial statements we just saw. And then to get ready for the next period, we journalize again in the general journal. Again, this is the general journal here, and this is the same general journal here. Same general journal here, but now we're journalizing those 4 closing entries and posting them to the same ledger accounts. And we pull those balances now into the last trial balance for the period called a post-closing or after-closing trial balance. Now we're ready to start the cycle again, recording transactions for the next period. Okay. Let's see if I can. This video is getting too long. I'll summarize it. This accounting cycle in the next video. Okay. So take a look at our last video.